Make sure sound is turned on. All right, welcome to class. We have 11 people concurrent there, so there's 11 people logged in at the moment, so that's good. Robert is taking attendance over here, making sure that he gives everybody credit for the beginning of the class. And so we had an exciting week with the articles. I enjoyed reading what the articles that you found. The nice thing about you guys digging up those articles is I learned too. Because I can keep up with the latest things that are happening in each of the areas. So it's exciting for me to dig in after Sunday and between Sunday and today to read all those articles and to get a chance to learn a little bit more about everything going on. So there's a couple of those articles that I'm going to feature tonight, actually. Two of the subjects are going to come out of articles, although one of the subjects is going to be not about the article, but about who wrote it, which you may find a little bit interesting. So we have 12 people concurrent right now. We've had 17 views, so that's interesting. 17 people have come in and out at least, and 12 have stayed. So that's probably not unusual because I do advertise the live stream with my current subscribers. So that's a good thing. So all right, Robert, let's pop up my first topic today. All right. What I'd like to do is I'd like to introduce you to boy, can't speak today.
We're trying.
A little bit of technical difficulty there. We've got to turn the camera on. Okay. So you got this good look at my forehead. All right, I'd like to introduce you to Adam Smith, science and technology reporter for The Independent. Okay. And if we read his bio, it says Adam Smith is a science and technology reporter at The Independent, having previously written for PC Magazine, which should give him some qualifications, The Guardian and the New Statesman and Prospect. He's interested in how technology is affecting every aspect of our lives and the power dynamics that have arisen from it. I have no idea what he means by "and the power dynamics that have risen from it." Oh well, we may find that out. So Adam Smith, of course, has a namesake, and I'm going to contend that his namesake is a little bit more knowledgeable about life than he is, because he makes a really boneheaded statement in his article. Now, the article was submitted by one of his students, and I really appreciate being able to read it because I have a good laugh when I come to certain paragraphs that relate to blockchain, and they're supposedly written by these wonderful experts, this wonderful science and technology reporter. So one of you will remember that they posted YouTube launching NFTs. I can say that I'm not all that excited about people owning my videos. So yeah, we'll figure that out when time comes. So we'll see. It says they're thinking big by doing so. Well, we'll see. We'll see. But the interesting statement here is when he tries to give you the idea that, okay, and YouTube is launching NFTs, but NFTs are just horrible things. They are just awful. And I love his paragraph down here. Okay. There we go. He says, it has been estimated that the average NFT has a carbon footprint equivalent to the monthly footprint of someone living in the EU. Wow. The people in the EU don't burn much carbon, because when I checked it, an NFT cost me $1.35 plus a gas fee. Now the gas fee, varies, and it can run anywhere from $60, $70 up to $300 or so. But that's hardly what is spent on energy by somebody in the EU. That's totally absurd. And then he gets even more absurd as he goes forward. He says, while the cost of Bitcoin's environmental impact has been well documented, with analysis from the University of Cambridge suggesting that its network currently consumes more energy than the whole of the Netherlands. Oh my gosh! The Netherlands? How much do they consume? How much does Visa consume to maintain their network? Or MasterCard to maintain their network? Or the SWIFT network? I mean, how much computing power and energy do they take in order to process all the massive number of transactions that they process on a daily basis? Let's break this down a little bit. For one, no NFTs are created on Bitcoin. It doesn't happen. The two major blockchains that have NFTs created are Ethereum and
Solana.
Solana. Thank you, Robert. So Ethereum and Solana are the two major creators of NFTs, and because those two create all the NFTs, a comparison with Bitcoin's consumption is quite absurd, actually. Solana is a very small network, has nowhere near the impact that a Bitcoin network has. And as we've heard in a previous video, Ethereum just switched to proof of stake, which stops all of that mining and becomes totally carbon neutral, as far as, you know, the environmentalists want to say it's carbon neutral. So I love when a writer just sticks his foot into it and really gets in the muck, because this is totally an absurd statement. Because here he's writing a positive article about NFTs and the technology is going to be so cool, and then he comes down here, but NFTs cost so much and they put out a ton of pollution. And because they put all this ton of pollution out there, we should, you know, give it the FUD award of the week. Fear, uncertainty, and doubt. And that's really all I have to say about Adam Smith. See ya. I think we'll take a quick break, change up my pictures on the screen, and be back in 2 minutes. Alrighty, we're back. Hey, Steve, thanks. I appreciate the compliment there. You know, you wonder if anything is really news to me. Honestly, all week long I'm reading article after article after article, And some of the posts are articles that I have already read, and so they aren't news to me. So I kind of pass them over. But you guys do go to different places than I generally tend to go to. And so this next topic was a surprise to me. And I guess it really shouldn't have been. So I'll launch into that here in a second. So we'll, just to give you an idea, Steve, I roasted an analyst from the Motley Fool last class because a guy from the Motley Fool tried to be a Debbie Downer on blockchain and crypto. And so because he was just trying to be negative, but he was saying stupid stuff, I just couldn't resist it. You'll find that video if you look for it. It's the title is something like "Making a Fool of Motley Fool" or something like that, or "The Motley Fool Makes a Fool of Himself" or something like that. So yeah, find that one. It's funny too. It really is. All right. Well, what I'd like to do now is talk about the SWIFT financial messaging system, because obviously they are not going to give over their position as the world leader of interbank transfers for companies, cross-border transfers, very easily. Obviously, they're going to try to stay on the edge of technology, and so they ought to be, I guess. I shouldn't have been surprised when I came across, when one of you came across this this article, because it just makes a lot of sense for them to do so. So the Society for Worldwide Interbank Financial Telecommunications, or SWIFT, is piloting a project with a company called Symbiont. Now, I've heard of Symbiont before. They are heavy into the financial world, and they're heavy into, developing financial solutions for interbank communications. And a lot of times they're using things like Ripple, or they're using, other cryptocurrency type of methods in order to make interbank transfers or cross-border transfers more easy and more and less costly. So they've been in the market for quite a while. So it doesn't surprise me that an organization such as SWIFT is working with them. So SWIFT, I liked the statistics here. SWIFT delivers secure messages among 11,000 companies over 200 countries and territories, directing trillions of dollars in transactions. It is a big deal. It's a big deal on the level of a Visa and a MasterCard. I mean, they're one of the stodgy old line financial institutions that isn't going to rest its hold on its position in the market not very easily. They're going to try to hold on to their technology and keep advancing it so that people don't leave them. And frankly, the fact that the BRIC network has developed SIPs in competition to it, and then allowed Russia to get into that network so they could continue cross-border transfers among the BRIC countries, belies the fact that SWIFT is losing part of its market share always. Now, part of the interesting thing with SWIFT is that it's based on the dollar, and it is part of the US dollar dominance in the world, because SWIFT requires that if you're going to do an interbank transfer through them, that it goes from dollars to whatever currency, or from currency to dollars and then to the next country. So it requires the dollar, therefore requiring the dollar and directing trillions of those dollars a year is going to be hurtful if they lose their place. Hurtful to the U.S. economy is what I'm really trying to say. So they're working with Symbiont in order to innovate in that payment space to try to lower costs and increase efficiencies. So they're working with several other banks too. So they're using smart contracts, which means they're using either Ripple or Why am I having a hard time with words today?
I don't know. Are we talking about Ethereum and Solana again?
No, Ripple and the other country that did interbank transfers.
I don't recall.
That's terrible. You're supposed to be my favorite assistant. My assistant failed me. Is your mic on?
No, sir.
They ought to be hearing this. Okay. Anyway, you'll cut out all this in the final video anyway, right?
Yep.
Anyway, so they're using smart contracts, of course, which are found on Ethereum mostly, and they're found on a couple other networks that try to compete with Ethereum. So they're using those smart contracts to increase efficiencies, which just makes a whole lot of sense. I will be anxious to see more news as they continue to work through creating the blockchain and see if they can integrate it with the current SWIFT network, because that's going to create more efficiencies and then it's going to push people away from using true cryptocurrencies like Ripple or others to increase their ability to do cross-border transfers, because a lot of those companies that are going to Ripple and other places are trying to get out of SWIFT to do those transfers because SWIFT is so expensive. So they're going to try to hold on to their market as best they can. So that should be all for that subject. Okay, Robert? Okay, we'll take a quick 2-minute break. I'll change out my thing, and then we've got a topic that'll take us to the end of the hour. All right. For the next 2 segments, what I want to do is talk about 2 aspects of a distributed finance company called Compound. Compound is one of those companies that was successful in making it through the downturn when Bitcoin was at 60,000 and went down to 20. So they are a success story, unlike the others that you've heard with Voyager and Three Arrows and the other crypto DeFi distributed finance apps that have gone under. So I want to share with you why they were successful first. And because they were successful, I'd like to highlight them, because I think you need to know that there are, in fact, companies out there that are in this distributed finance space and are making a success of the space in spite of the challenges with the crypto prices. And the way to do that is to be conservative. So one of you submitted a Cointelegraph article. I've got two of them that I'm going to show here. This first one, though, I only want to come down here to a paragraph that tells what Compound looks like right now today. They currently have $3 billion in assets, and that's critical. $3 billion in assets means that you've got a solid foundation that you can work from and build from. They have handled as much as $285 billion in transaction volume since the company began. So they've been in existence for 3, almost 4 years now. And being in existence that long, they came into play long before, quite a bit before, during the run-up of Bitcoin and through the entire crash. And they've come out on the other side, and they're continuing to expand. So the point here is that Compound is an asset management software similar to a bank. And here, Robert, I'm going to need to go full screen. I can't get enough of the screen.
Give me one moment to figure out how to do that. There we go.
Okay. I'm going to need to get more of the screen there. Now I can get the rest of the screen. Okay. All right. Robert took me off this. Changed the format there so that I could be able to use more of the screen here. And the point here is that this right here is the user dashboard. If you're a normal, everyday investor like you and me, you're not an institution, is really the distinction I'm drawing. So you're not a major company. You're not an institution that does other investing. You're not one of those companies that, on the other side of the fence that I'm going to talk about in a few minutes, would need larger dollar transactions, okay? So what Compound did is, this is where they started. They started with you and me and the guy down the street. They did not try to start with the $1 million, $2 million bogeys like the other companies did. So what happened with the other companies that gave them so much trouble is they gave huge loans to other institutions, and they had it collateralized with Bitcoin and with other cryptocurrencies. Now, you'll notice on the screen that they do have wrapped Bitcoin, Uniswap, Ether, and Chainlink, okay? They have these, and you can also deposit comp. You can also deposit US dollars and convert them into the US dollar coin, which is supported by Coinbase. Now, Coinbase is the major backer to Compound. And if you know who Coinbase is the largest US-based exchange, Now, they're the second largest in the world, so it's not that they're small by any means. They have a lot of financial strength behind them, even though they're laying off a lot of people because of the crypto downturn. Now, what happens here is you deposit your money there, and you earn 2.4% if it's deposited here in US dollar coins. So you put your dollars in, you convert them to US dollar coins, and then you can borrow out whatever currency or crypto that you want. Here it shows the collateral value, and here it shows the liquidation point, which will be 90% of this collateral value. Okay, your borrowing capacity would be the same as this. Now, pardon me, liquidation point is the point at which, if the borrowing capacity starts to exceed 90% of your collateral, then there's a point here where you would have to liquidate some of your loan. In other words, pay back some of your loan or put more coin in to collateralize and make sure your loan was fully collateralized. Now, the point here is that Compound made sure during the whole downturn that everything stayed as closely collateralized as it could be. They closely monitored it and closely they stayed strict to this liquidation point, and they forced people to liquidate when needed, to pay back loans when the collateral value was going down. They made them change into, let's say, US dollar coin, get into a stable coin when Bitcoin was going down. They worked with their clients to make sure that they could stay collateralized so that their loans would stay covered and their borrowing capacity was still guaranteed. And by doing so, they continued to grow step by step, day by day. Not flashy. You didn't see them in the news a lot. You saw Coinbase and so forth advertising it on their site, but you did not see them, flashing into being, and all of a sudden they're big and huge. Like some of the other companies, like Terra and like Voyager and like the other companies that have gone south so fast. The reason they didn't grow real fast is because they kept a conservative stance. That conservative stance enabled them to continue going forward. So this is how compound works for the individual. Okay? And so what I'm going to do now is I'm going to switch to the next phase of compound's growth. So we have this article that was also one of the two articles from the Blockchain News. Now,
you're good.
Okay. Okay, we have another article from the Blockchain News. Robert's being funny with me. Okay, so this particular article here was related to the other article in the fact that both of them talked about the compound treasury launching borrowing for institutions. So their first growth phase was with individuals that put money in, collateralized their loans, borrowed up to 90%. They borrowed it at 6%. They got interest on the money that was parked there for collateralization. They got about 2.45%, I think is what it said on the screen. So the delta between those allowed, Compound to keep paying their bills and keep growing as they continued to march forward and gain more depositors and build more loans and get more loan payback and more interest and slowly grow. So now they've got this big war chest. They've got cash in the bank. They've got $3 billion worth of assets. Now they've opened it to another level, which is institutions, large companies, other investment houses, and so forth that want to come park money. Now, why would a company do that? Okay, here's why. Let's say a company like Boeing. They have the Treasury Department in Boeing, okay? And they've got treasury stocks, they've got real estate, they've got all kinds of assets that support and back up all of the rest of their operations. Some are more liquid than others, but they keep that money available so that they can expand or handle problems with a downturn or an economy problem. And when you're growing, it works great because you keep putting more money back into this backlog. Well, into this, into the treasury. So there are times, though, when you want to have something that's a little bit less liquid so that it earns more money. So you might have something like, Bitcoin or other more risky investments, but you need to be able to spend the cash and keep the cash liquid. So you can go to a facility like this and deposit those illiquid or less liquid funds and be able to borrow back cash, in the form of dollars. And you borrow back those dollars and you can then use those for current growth. It allows you to park your assets and still use the assets at the same time. So this is borrowing now for institutions. You'll see a new level of growth as Compound now moves into this phase of their growth. And if you go to the Compound Treasury, you'll notice that it has a little bit different look and feel. It allows clients to log in. And of course, I'm not a client, so I can't show you what it looks like after you've logged in. But here's kind of an example of how you deposit funds. You do it through a bank wire, or sometimes they call it an ACH. Sometimes you when you work for a job, they'll ask you for a check or your bank account so they can set up an ACH to deposit your paycheck directly in the bank. That's the same kind of facility as what they're doing here. So here's the opening screen, and they give some interesting information. You get a good predictable yield and liquidity both. And that's the point I was talking about there, where a company will want to keep a certain amount of money parked, but they'll want a certain amount to stay liquid. And this offers the ability for both. And here you've got them touting the 285 billion in transactions total and 3 billion in assets. So this is right here on their webpage. That was obviously the article quoted from there. So here you've got money being deposited, and they expect that money is going to be deposited in larger amounts than you and I would probably deposit. So, I might have, 30, 40,000, 100,000 or so to deposit because I'm putting my retirement funds in there or whatever. Something like that, and earn a fixed APR of 4%. So you can then earn with that money, but then on this side, you can then post it as collateral. So all these deposits can be posted as collateral, and you can put it in Ether or Bitcoin or any ERC tokens as collateral. ERC tokens would be anything from the Ethereum blockchain. And then you can borrow it back out at 6%. You can borrow up to 90% of your collateral. Okay, so it works very simply, and as the model continues to function and as Compound manages the process, and the process being you can only borrow 90% of your collateral if the collateral value goes down. Like, let's say you decided that your collateral needed to be in Bitcoin because you could see that the market was going to go up for sure, but it actually goes down. That happens sometimes. So if it goes down and all of a sudden you're collateralized at 95%, you've borrowed up to 95% of your collateral, the way that Compound makes sure that everything stays even with the board is they'll come back to the person or institution in this case that they're working with and saying, okay, we've got a 5% deficit here. You need to pay back some of that to move that back down to the 90% level. And of course, they could borrow it back as soon as the Bitcoin rose back up if they wanted to. So it's a new facility. It's distributed finance, which means that they are able then to have this operate, and basically the analysts are back there just watching and making sure accounts don't get out of balance. They run in the Compound offices, they'll run reports that'll look for accounts that are struggling or having trouble. They'll get in touch with them. They'll make sure that they work with those clients to make them to get them built back to where they should be at the 90% collateral value. Realistically, most institutions would only borrow back maybe 50% so that they can be sure that they don't have an emergency situation like that. And so the offices are watching out for that stuff, and the clients basically have a good, stable interface that treats everybody the same. There's no qualifications. You deposit your money, you can borrow it back. You don't have this guy sitting behind a desk, really, really important, saying, no, you can't have that loan today. I love that. I hate bankers. I really do. This really would fit for me. So I hope you've enjoyed this little time that we've had together.
We actually have a good question from Cameron.
We have a good question from Cameron, but I took it off the screen, so I'm not seeing it. So let's, maybe we should put it back up on the screen.
Okay. Well, let's bring you back up there, and I'll give you your comments back.
All righty.
What browser are we using for this? Are you
Brave.
using Edge? That's silly. Who uses
Oh, we were
Edge?
using Edge? How did we use Edge? How did I get into Edge?
Well, there you go.
Okay. By the way, Kat, we did see you come. Thank you for coming. Appreciate that. Cameron, are you taxed on your borrowing? No. The money's yours. what's kind of odd about it is that you're really borrowing your own money back. So no, you wouldn't be taxed getting that money. You'd be taxed on increases that you get from parking your money there. So that 4% that's being earned on that money would be considered interest, just like interest you get at any other bank. But no, borrowing it out's not going to create a tax liability that way at all. No. Okay. Any other questions? Let's open it up for questions. What time is it, Robert?
It is 6:37.
It's 6:30. I don't want to let you leave 23 minutes early. I'd really like...
I actually did have a comment to make about, what is this called?
Compound?
About compound again. One of the biggest deficits that Bitcoin and a lot of cryptocurrencies have is they're not very liquid. Either they cost a lot of money to send and receive, or they're too volatile. They're just very difficult to use for actual goods and services, which was kind of the initial premise of Bitcoin itself. And to me, this is kind of bridging that gap a little bit, trying to make blockchain or make cryptocurrencies more accessible to people again.
Yeah, and it definitely does. Definitely does. So, you've heard of margin buying in stocks? You know, that's when you go to a stock exchange or a stock broker and you set up a margin account. And the margin account is money you borrow, and then you go invest that borrowed money into stocks. This is similar, only it's backwards. Here you deposit the money and then borrow it back, instead of a stock type situation where you borrow the money and then go buy the collateral. That's weird. And then you have what they call a margin call. If your stocks go down, and very similar to the point here. So really, Compound is based on a system that has worked for a long time. The idea of buying stock on margin and margin calls. It's the same sort of model. It's just a little bit backwards. It's all. Okay. All right. Do we have any other questions?
Now you can wait a minute for responses.
Yeah. All right. Obviously, I always need to have a fourth topic because I didn't obviously have enough run space. One thing that I have been doing, though, this week, just to give you an idea, I've done a lot more research, and you'll see a video coming out on central bank digital currency for the U.S. again, because the White House sent out what they called its framework. And basically what its framework is it was detailing out which part of government was going to look at which item. And I'm working through that document right now to put together a chart so that you can see all the different branches of government and all the different pieces and parts that they're going to be doing research on and bringing back information to the larger group and advising the Federal Reserve on the information that they gather, okay? It still hasn't been determined whether the Federal Reserve is going to do the deployment of the digital currency, or whether it's going to be Congress that does it, whether it's going to be the U.S. Treasury that does it. There seems to be this little bit of tug of war growing as to who's going to get to do it. At this point, that's what it feels like to me. We'll have to see, turning into a little bit of a turf war here. And I have a feeling that the flavor of that framework document was just to tell everybody, okay, guys, this is your part, and this is your part. And so I will be putting a chart together that will basically detail out what's going to be done by what people. Then what I want to do is drill into each one of those organizations and see what information they post as to their progress and what they've done up to that point. Find what the deadlines are. Find what the information coming back looks like and what they're finding, what they're recommending. One thing that's really comes out strong in the document is that they do not like stablecoins. They do not like them because of Terra, that just crashed from being pegged at the dollar mark, and they went down to a penny. They've retraced some of that distance coming back up to $1, but they've not come back all the way yet. The company that was running it is in bankruptcy and probably won't emerge out of bankruptcy. So I don't think that there's any chance that that's going to happen. So one, this document labeled out the problems with stablecoins. They labeled out the challenges with monetary regulations. Kind of gave you a feeling like they thought that the cryptocurrency was the wild, wild west, and they needed to control it. And that's always kind of dangerous too, to let the feeling that the government's going to put more and more controls on Bitcoin. In fact, one of the articles that I read this last week was about the fact that certain states, and it's a state-by-state deal, certain states will not let you contribute to a campaign for a politician unless if you do it in Bitcoin or do it in any cryptocurrency. In other words, you can't make a cryptocurrency donation to a campaign. Arkansas is one of those states. That's where I happen to live right now. And California was another one of those states. So it's, whatever flavor. So if a person wants to donate, they can't donate in those states in cryptocurrency. So that's kind of a bummer, just because of reporting. They're afraid that, and unfortunately, it's a fear of. It's not reality. If you get money from somebody, they've got to label who it's from, or you just reject it, you return it, or donate it to another cause. You can't keep it as a politician. You've got to identify where all the money comes from. That's just the way the laws read. So, what other interesting stuff have we come across this week? The world is fast changing. That's the whole big thing. Is cryptos are changing the world. The idea of blockchain is changing the world. Technology is changing the world in general. And unfortunately, we've got the nefarious side of it and the good side of it. You've got people wanting to use the technology for good and the opposite. So, we're just going to have to watch. I am not convinced that the government can handle a central bank digital currency in my best interest. If I want to spend money on something that's philosophically not what the government wants me to spend money on, are they going to be able to just stop that transaction or seize the money out of my bank account because all of a sudden I'm talking against the government or something like that? It's definitely a curb to free speech if that's going to be the case. So I'm a little bit concerned about that. And so that's one reason why I want to watch it so close, and why I want to report to my audience anyway, what is going to happen as the investigation into issuing a central bank digital currency in the U.S. gets closer and closer to reality. So.
Can I say something?
Please do.
Sure. On the topic of regulation, especially of cryptocurrencies, we're seeing such a quick evolution of the technologies available. Distributed finance, like what we've been talking about today, only began, the ERC20 token only began in 2017, if I remember correctly. So it's very, very new. Regulations, however, are forever. They rarely get amended and repealed and changed. And so if the government gets involved too soon trying to prevent fraud and bad actors in the space, then we stunt the growth and the potential that blockchain has to revolutionize the world. However, we also see daily more and more fraud happening within the crypto space. Mm-hmm. And personally, I'd much prefer more openness and transparency for new crypto-based projects, and for the government to enforce some of those promises given to their users instead of proactively declaring exactly how everybody should run their own projects.
Yeah, and that is true, because in the crypto space is in its infancy, literally, and the developments can only happen if they're free to develop in a free and open space. If those cryptocurrencies or those crypto projects in the distributed finance space had not failed, we would not have found those weaknesses. Now, a lot of people lost money, and that's a sad thing. But at the same time, those projects enable us to see the weakness that can be patched next time. Compound found a way around it. Other distributed finance applications are growing up, and they're going to learn from the mistakes, and they're going to learn from Compound. As we go further, we will get better at doing the new projects and get better at overcoming the challenges of the past. Everything gets stronger as things go along. Quick story, and then I'll let you go. Back in the 70s, we had a lot of fear of global climate change. I'll call it climate change today because back then it was global cooling. We were headed for the next ice age. We were going to have acid rain was going to kill us all off. We were going to run out of oil, and everything was just going to go downward, and society would be just totally devastated. Well, we're still here today, 50 years later, and all of the people crying wolf back in the 70s are back at it again, crying wolf again. I believe in technology. I believe that technology and science and people who want to use it for good can find a way to do so, and it will keep on running forward. That's why I love talking about blockchain so much. So everybody, Robert, if you want to post the final attendance, I'll let you all go after you tell me that you're still here, and we'll look forward to seeing you next week. Now, if I happen to see another question come up in the next 5 minutes or so, I'll stay on the line here and answer those questions. And I'm wondering who the 16th person that dropped off is not here, because we got 15 people online now. We had 16 people through most of it. All right. Megan Murray signing off. I like that. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Come on, number 15. 15. Okay, 16. Nick, again, 17? I think we're getting a bad reading down here.
I think so.
I think so. Hey, thanks all for coming. We'll look forward to seeing you next week.